A slew of retail earnings coming up next week, and we're going to talk about that and maybe touch on United Health yet again today on Office Hours on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Interest Office Hours with Professor Mark Guthner of Rutgers. Mark, how are you?
I'm terrific. The school year is finally over. We had commencement for the undergraduates yesterday, and I'm looking forward to getting a little downtime.
It looks like you're in your home office today, but you mentioned you have some bad weather over there, so we might lose you if the power goes out, huh?
Yeah, we got some serious thunderstorms going. Not supposed to last too long, maybe till 3 o'clock, but that's the duration of our show.
Yeah. I also apologize because I got my own thing going on here. The gardeners are outside with their leaf blowers. You can probably hear that in the background, but hopefully they will be done soon. It seems like they've gone right by this window a couple of times, so I don't know what's going on there. Let's touch first on United Health. This is a company I know you're familiar with. You and I both know somebody who ended up going to work for that company, the former head of research where you and I were formerly employed at CRT Capital. This is an interesting one because the price action was really miserable this year, even before the latest news announcement. So just as a quick recap for anybody who hasn't seen some of the prior live streams or hasn't really been following along, United Health is the nation's largest managed care health insurer. They employ over 400,000 people. It's the third largest company in the country by revenues, trailing only Walmart and Amazon. It recently surpassed Microsoft for that third place spot. So we're talking about just an absolutely massive company. It was sawed in half, basically coming into this week. Reasons for this included they had an earnings miss when they reported in April, not something that they have commonly done. And they reduced guidance at that time for the full year. Then on Tuesday, I guess it was, the company announced that their CEO, Andrew Whitty, was resigning for, quote, personal reasons, unquote, and they withdrew guidance altogether. This is only a month, not even a month, I think, since their last quarterly earnings report. And the former CEO, the one who basically spearheaded much of the company's growth, stepped back into that role. I had only just gotten done talking about these things when the Wall Street Journal reported that the Department of Justice is investigating the company for possible improper billing of Medicare. So, any thoughts about this before I get into some of the more of the specifics and how I'm kind of thinking about this now?
Well, yeah, there's also the media has a role to play in the beatdown of the stock. The Wall Street Journal wrote an article. I've seen a few shows, and I think they discussed this on Fast yesterday. But the Wall Street Journal says the government's in there investigating the company for fraud, maybe some criminal activity. And UNH's response was, that's news to us because the government hasn't contacted us about any investigation into the company. So who knows, what's true or not. I don't think the Wall Street Journal shared their source. And so that's always, what's the word I'm looking for? Suspect to me when you write a story in these days of trying to grab eyeballs and getting attention and trying to do things a little over the top to compete for people's attention. The use of unnamed sources is a common practice that I don't think provides a lot of legitimacy. So I don't know really what's going on with that side of the story, but that's certainly something that's giving a lot of people a big scare because, who's their biggest client? Well, it's the government, right? And if the government thinks they're doing something funny, and especially with this administration, they, fines and penalties and maybe clawbacks could all be in the mix, and that could be quite ugly. So I think people who are trading the stock are not overreacting to the kind of news that we have, because, well, I think the probability that there's something really wrong there is rather modest. If there is, the magnitude of that problem is going to be big. At least that would be in my estimation. So a small probability of a really ugly event, and people are trying to discount that and get that reflected in the share price.
Yeah, so let's talk a little bit about that magnitude. So, looking to buy stocks on the cheap, like United Health, we have an expression for this. It's trying to catch the falling knife, is what they say. And yesterday, I actually put an article out. Actually, I put an article on the Options Edge website on Wednesday night, and I put one out on CNBC Pro's website yesterday. The 240-7300 call spread risk reversal. I just felt like it might be a little bit overdone here. So, but I think it's important for people to sort of understand the magnitude of the issue. So first of all, United Health, in addition to being the largest in the space, is the largest in the Medicare, Medicaid space as well. They've actually pursued this as a strategy, a business strategy, more aggressively than have some of their smaller competitors. For full year 2025, about 15% of the company's revenues are anticipated or were forecast to come from government billings to Medicaid, and 16.9% were for, and this is where the allegations from the Wall Street Journal's reporting supposedly come into play, for Medicare. This is the Medicare Advantage area. So when we look at United Health Group, so folks will remember that United Health CEO Brian Thompson was killed outside of the Hilton in New York late last year. That was for United Health United Health Group, which is the parent company. That was a subsidiary. That's the CEO, Andrew Whitty, who stepped down earlier this week. They have a number of different businesses. So their other business is something called Optum. Optum is not necessarily an insurer. Supposedly, they touched over the course of the last year something like 120 million individual people that they serviced in one way or another. And when you consider that 90% of their business comes from the United States, that's an extraordinary number. We're talking about 1 in 3 people interacted with United Health Group through their Optum division. And then on the insurer side, they cover about 50 million people. So not quite as much, but that's more than 1 in 7 people in the country. So it's, when you talk about the magnitude of the potential problem. Now, the other side of it, though, I would say, is that, the company had 6% net income margins on average, if you just go back over the course of the last 10 years or so. Slightly better than their competitors, but not wildly so. And considering their competitive advantage, maybe that wouldn't be such a huge thing either. If you think about Home Depot and Lowe's, 100 basis points, what's that? What do you think the damages could be, though? You sort of alluded to clawbacks. I mean, I assume that this administration wouldn't take kindly to any kind of fraud, waste, and abuse. I mean, even if they wanted to be business friendly, they can't be.
No, they've got what's good for one is good for everybody. And if they're ripping off the government, if anybody is ripping off the government needs to address that and get their money back. I don't care who it is and for what purpose or what reason. Everybody can make a decent profit doing fair business with the government. I think they would probably be pretty ruthless, and I would applaud that.
Yeah, I think that makes good sense. I mean, they've been the biggest in the space. Like I said, 30%, probably a little more, 31-ish plus percent of total revenues this year. But that percentage of the company's revenues has been growing through time.
Yeah.
It's hard for me to imagine, I could be wrong on this, but it's hard for me to imagine that a major U.S. company that was trying to expand in a certain area that you'd have some. I mean, what's going on there? That a bunch of employees conspired to, let's defraud the government. I don't imagine that that's what we're talking about. It seems unlikely that it would be that kind of explicit activity. My guess is, so for people who don't know, there's something called V28. So when you deal with the government, it's always a complex situation, because the government is trying to, to some extent, mitigate expense, and this has to do with the classification that they assign to the things that they're charging for, and apparently that has changed through time. So I'm just going to take a complete stab in the dark here, and say that basically the way the incentives align, the company has certain incentives with respect to how they classify diagnoses for reimbursement. And, perhaps they were aggressive in this area. Maybe not. I'm not suggesting that they have been. I'm just saying that, to me, as I think about the process, which is that you have to bid to the government, that would be an area where they might have been bending it a little bit, if they're doing it at all.
Yeah, it's possible. I heard one guy on TV talking about sort of the nuances of what's going on, and he pointed out that there's an advantage to companies that are providing these services to essentially provide as much service to a customer as possible, whether they sort of need it or not, because it gets worked into a rate base and it's constantly added back to the monies that get charged to the government. So, base Medicare, they're charging the government. It's the plus, doctor's visits and prescriptions that, we pay extra for with Medicare Plus, which I have to say, somebody who is now eligible for it, it's very confusing to try to figure out what is the best plan. The way they're marketed is very confusing, because you get a barrage of stuff in the mail, you get a barrage of phone calls, and nobody really cares about, just buy our plan, because they're all commission salesmen cold calling your house. But in any event, he talked about how, if you don't really have a disease they want to start that is really problematic, they'll still want to start treating it right away, because ultimately they'll start getting reimbursed by the government. So I don't really see these companies as being a true insurance company. You think about insurance. I get insurance on my car. I'm trying like heck not to get in the car wreck, but if I do, I'm taken care of, right? Or life insurance. You buy life insurance, you don't want to pass away, don't want to die, and you're trying to live as long as possible, and you lock in a rate for the duration of your policy. That's not how healthcare works, because they essentially reprice the health insurance. And I always thought of health insurance as not insurance, but health finance. You're essentially, spreading your expenses out over your lifetime by making an annual payment. In some years, in fact, most years, you don't charge very much, and the insurance company makes money. And then you have, a big deal. Something happens, you get really sick, you have a hospital stay, and if there's anything that'll give you a heart attack, is seeing your bill for a 1-week stay in a hospital. That'll do you in right on the spot. So, and then of course, as those prices go up, they keep just getting ratcheted through the system. They charge the customers more, the government gets charged more, Medicare gets charged more. So I think that's why these guys have a very steady 5 or 6% profit margin year in, year out, because really all they need to do is kind of predict what they think their expense line is going to be in the upcoming 12 months, and then price their product appropriately, lock in that 6%, A year goes by, they're a little high, they're a little low, they adjust it again for the next year, and that just goes on and on. And I'm sure that they have very sophisticated models that give them a very good idea of what the customer demand is for all sorts of, medical things. And so I think it's very predictable, and that's why you look at their stock chart, it's so beautiful. It's just, they make money.
Metronomic in terms of its sort of geometric growth over the course of time.
Yeah.
Let me ask you this, because this is what occurred to me as I was thinking about the distinction between the Medicare and Medicaid programs that private companies like UnitedHealth offer compared to the individual and corporate health insurance plans that they offer.
Mm-hmm.
And I was thinking that the former group, the services that they bid on, and in fact the bidding is due any minute, and I guess that's one of the threats, right? That if the government could say, okay, you can't bid on a certain amount of business. But the way I was thinking about it is, unlike conventional health insurance, when they provide these services, they are more like a military contractor, that they're basically delivering goods and services to the government on a cost plus basis. That's how kind of military contracts work. And it's one of the criticisms that the military contracting process has faced, that the military, this is something that the folks at, Joe Lonsdale and other people who have now started companies that are providing services to the Defense Department have said that in a cost-plus world, the contractors do not have, like the defense primes, and in this case we're going to be talking about sort of the health insurance primes, they don't have an incentive to cut costs or to mitigate waste, because just the more stuff happens, the more they'll make, because they're going to make some margin. So they would much rather that the costs are 100 billion instead of 50, or 200 billion instead of 1. Whereas in a conventional health insurance framework, you're trying to offer a competitive product that's affordable enough that people will actually write the check, and then trying to minimize the amount of payout that you actually make towards expenses. Do you kind of look at it this way, this portion of the business?
I did. I did some of this kind of stuff way back in the day when I worked on Star Wars, when I was an engineer. And some contracts were cost plus. Some of them were an explicit, you could identify a return on capital. And so if they went over budget, the contractor had to eat it. Those tended to be things that there was not really any technological risk. A big reason that the government's willing to go along with cost plus on certain things is there's technology risk, that the ability of the contractor, the technology to do what the government wants, like with these new military aircraft, fighter aircraft. It's why they have so much problem with that. We're on the very edge of what technology can do, and maybe it works and maybe it doesn't. I remember we built 50 what seemed like enormous bottle rockets. They're about this tall and about this big around, had a little cone on them. There was technology in the front end with a big piece of lead, and it would steer, and it didn't work very well because the microprocessors weren't fast enough. But what we were doing was a technology demonstration to see if we could get it to work, and the government paid money. I don't know if it was a fixed, that particular one, it's too long ago, fixed price or a cost plus, but it was like, give us an idea if we can even do this. And then they give them a bunch of money to try to do it. And there's a lot of frontier engineering taking place with the military, and so that's why they do it. You're exactly right, though, that the incentives are to have more expenses, because you layer on a profit on top of every dollar you bill or you spend. So there's not really an incentive. Not only is there not an incentive to cut costs, there's an incentive to spend more. And and the world being what it is, people and companies will do what it takes to maximize profits. It is what it is.
Yeah, it's interesting because when you think about government spending, one ought to recognize just how much of it comes in the form of transfer payments
Yeah.
and payments for things like, contracted work. Because, if you figure, let's say that there's about 3 million employees of the federal government in one capacity or another. And I realize that I think there's like 2 million full-time employees of the government. Then you have the Department of Defense, which is going to include everybody in the military and everything else. But just to keep the math easy, and let's say that the annual federal budget is 7 trillion. It's actually slightly more than that. I think it's like 7.2. Okay, so if we divide 7 trillion by 3 million, that's $2.3 million per year per government employee of federal spending.
Yeah.
Now, you pull all the transfer payments out, and you're going to get down to something like 2 trillion or so, I think, of discretionary spending. Does that sound right to you? I think it's in that neighborhood, right?
Yeah.
And then we yank out. I mean, I guess my point is that the amount of spending that the government does on a per employee basis is almost unprecedented compared to any private enterprise, even once you redact the transfer payments. And a lot of money is going towards kinds of the things that you were talking about. Anyway, I guess the short version, we'll button up this United Health conversation. I recommended a call spread risk reversal. My thinking was, is it possible something nefarious is going on? Of course it's possible. In fact, I would guess that there's a lot of improper billing that goes on to the government. I don't know that United Health is responsible for any of it, but I'm sure there's a lot of it that's going on. What do you think, other than a clawback, what do you think are the other potential penalties? There's probably a potential antitrust thing in here too, because United Health being the biggest company.
It is, but they might just say if there's fraud, then that's a criminal offense, and depending upon the size of the fraud, the fine for that could be enormous. I'm not a lawyer, and so I wouldn't be able to handicap a size there, but yeah, it'd be a huge number. And the question is, bigger than that is how if they go for clawbacks. You guys took money that was not rightfully yours over X number of years. That could be an enormous number.
Yeah, I mean, I guess, yeah, I mean, I was thinking, is this a treble damages type of case? I don't know.
Yeah.
They've been the largest in the space for a decade. 30% of the revenues. This is a 450 billion full year revenue guide business. So we're talking about 150 billion dollars in billings to the government anticipated for 2025 alone. So you're right. The numbers could be enormous. Like I said, I'm kind of speculating on the notion that maybe it's not going to be as big as some seem to think it is. I mean, this is a company that typically traded at a premium to the markets. It's trading. Let's see where we are right now.
Huge discount. Well, there's the other issue that no matter what happens, the government's not going to want to put them out of business.
Yeah, I mean, it's over 400,000 employees there, and also they're plugged into every. I mean, I'm not going to call it a vital service, but it's an important one.
Yeah, it is, and there's a lot of U.S. citizens that are using that, so its impact would be enormous. The last time I can remember the government putting somebody out of business was Arthur Andersen with the Enron stuff, and it turned out at the very end, after lawsuits and appeals and so forth, that Arthur Andersen was found not guilty, but they were out of business by then, so it didn't matter. They were very caught up into this Enron and other energy problems where they were mixing, doing, I guess you would say, auditing on the cheap and turning a shoulder and eye away from some impropriety in return for consulting business, which was much larger margin. That's where all the money is at those firms.
So yeah, I mean that was an interesting case because and when I say they, I'm really talking about Skilling and Andy Fastow. Andy Fastow was the CFO of Enron. His wife Leah Weingarten was the assistant treasurer of Enron, and for those who don't remember, what they did was they created all of these sort of off-balance sheet special purpose vehicles.
Yeah.
And basically, they were pledging as collateral the company's own stock for massive loans, and they had all kinds of names, which of course looked pretty miserable with once they got uncovered in the light of day. Raptor and all these, they all sounded they sounded appropriately nasty. I think they were named after like Jurassic Park characters or something. Let's move on a little bit here to the retail side. You were talking about Target before we went live today. So we've got Target's going to be reporting, TJX, which has just been a rock star.
Yeah.
They've just done fabulously well. Home Depot, Lowe's, Ralph Lauren are going to be reporting. I've got who else on the retail side? We're affected by retail. We've got Ross Stores is going to be reporting, and then consumer names such as Elf Beauty, Deckers, which makes Uggs and things like that.
Yeah.
And VF Corp. So VF Corp, for people who don't know, that's ticker VFC. They're the ones that make North Face apparel, the ubiquitous JanSport backpacks, Timberland boots, things like that. And Zoom Communications, although I think Zoom's a little bit... Oh, Williams-Sonoma also. So why don't you touch on Target a little bit? Because I think Target's kind of an interesting situation. You know, you see some of these other companies like Walmart and Costco and BJ's all doing so fabulously well. Hasn't really been that way for Target. I'm going to pull up the chart.
Yeah, well, Target, kind of lost its way because of COVID, and they never made the hard decisions to just right themselves. And what I mean by that is when they did the lockdown, all of a sudden there were supply chain problems. So they did some enormous ordering, and they ended up getting product too late. They have product in their store that was at the end of the season, or maybe now it's even absolutely out of season. And instead of doing what Walmart, what Costco does, they reduce the price every week until the product's gone. They tried to hold on to the margins and try to sell the product even off season. And that turned out to be a really lousy strategy because they filled up shelf space with product that wasn't turning over. And that hurt. And it took them a long time to work off that inventory and sort of get themselves right-sized. I've been wondering for quite a while now when they kind of get back on track, and I wonder what's going on in their merchandising operation, that they're not getting, the right products in the store at the right time of year, which places like Walmart does very well, and Costco and others, because both those places sell some seasonal product that it's there in the store for 6 to 8 weeks, and then it's gone, and something new is there taking its place on the shelf. And listen, they've got the point of sale systems. They know exactly what their inventory is. They know what's selling and when it's selling. So I just kind of wonder about the decision making on the merchandising side. What are they deciding to put in to do that? Now, they did alienate a decent amount of their client base because they put up front and center a lot of product, pride related product. And so I don't want to get into politics of that. They made that choice. All I'm saying is the world didn't respond well to it. And so then they put it into the back of the store. I don't think it's in this. I don't remember seeing it in the Target. I go into Target every now and again to get something for my son. But they made That seemed to be, an unforced error. And look, when they get themselves back on track, it's going to be a fabulous stock. And I keep having an itchy finger to say, well, maybe you buy and hold this one for a 10-year hold. But, I need a little show me here for management.
So
doing it right.
Funny that you should bring up a 10-year hold, because the chart that's on the screen right now is a 10-year price chart, and what you can see is that the stock is essentially nowhere
Unched.
over the course, round numbers, over the course of the last 10 years. Yeah, I remember that whole hubbub. I guess my own thinking about this is that, people's memories are short. It was clearly a misstep. I never quite understand when the C-suite decides that they're going to wade into a fraught political issue.
Yeah,
It's just hard. It's hard to see how that can possibly be beneficial, particularly if the issue is one where the potential audience, the market that you would be serving, is relatively small, and I'm assuming that in this case it was. Anyway, it's fine. I mean, I think there's a ranking mechanism that was sort of promoted by many. I would say that Larry Fink probably had a little something to do with this, but ESG became sort of important, so important that it's sort of a default in things like the Bloomberg terminal, which we're sharing with you right now, that investors, institutional investors were looking at companies' ESG scores, and I think some C-suites said, oh, well, we want to be more attractively ranked in the ESG scoring mechanism. So, they were more overt about doing things that might improve their score. And I think that may have played into this a little bit. But I think that's something that the company can fix. I think it probably has fixed it. I mean, I don't hear much being said about it now. I don't get much of an opportunity to compare Walmart to Target or anything like that, because we don't have a Walmart close to where we live. We have some department stores. There's a mall to my north. There's a Target to my south. It's a relatively small one. But I wanted to show one other chart. Let me see if I can pull this over, because this is actually a much longer term one. Let's see if this works. Where did it go? Oops. Oh, there it is. So this chart right here, this is the forward price to earnings multiple for Target, and in this case it's going back all the way to 1980. So this is basically a 45-year chart of the forward price to earnings multiple for Target, and are we at the bottom of this range?
Pretty darn
No,
close.
but we're getting close. We're darn close to it now. And one of the things I think Walmart has sufficiently demonstrated, that's the beauty of the situation I think that Target faces. If they want to know how to manage their business, they have a great model. Walmart's trading 30 times, 33 times forward, I think, right now. This one's trading 11, 3x. So what has Walmart been doing? They've been focusing on digital. They were much better at inventory management. As you referenced before, Target had a problem with that, but I think they've resolved it.
Yeah.
And they've focused on grocery. Target has tried to bring some grocery in, not so much fresh produce, but that's the thing. I think if they start rolling some of that in, they have an opportunity here. And it's a speculative situation, because I'm not going to claim that they're completely out of the woods, but I'm kind of with you. From my perspective, they only have to start doing a few things better than they're doing them now to see a huge benefit.
Yeah.
They could easily be trading 22 times if they just get on track, and that would be a 50% discount to where, not quite 50, but we'll call it a 40% discount to where Walmart is trading right now.
Yeah. Yeah. And that's why there is tremendous promise or opportunity in the stock. And maybe we just need, I keep waiting for the earnings announcement that kind of says that makes it clear they've turned the corner. and they're off to the races, and then I'll be a buyer. I instead of trying to buy the bottom, I would rather buy after the bounce,
Mm-hmm.
kind of catch the middle of the move instead of trying to be a hero and say have bragging rights down at to say I bought it at bottom tick,
Mm-hmm.
because the chances of that are as close to zero as I can imagine.
Yeah, that kind of market timing obviously going to be very difficult. I guess the reason I was kind of looking at it here was just simply because it has basically fallen back to that 10-year price level.
Hmm.
And you actually indicated that you suspect that in the aggregate, that consumer names, that the retail names, that the earnings that are coming up this week, you expect are probably going to be a little bit better than the kind of negative tenor
Yeah,
that we're hearing from everybody.
yeah.
Um,
Yeah, I never thought the
what's your
economy
thinking?
was as bad as what people what were saying, either on the political front or a lot of the financial media. I just didn't think it was that bad. Was it as had it come off the boil? Sure, but I was not. I don't think it's a disaster by any stretch. So I think a lot of these companies are going to have mild beats going forward. And that's what I'm looking for, with decent guidance as well.
Hmm.
I think guidance is going to be okay, because yeah, the tariff thing is clearing up, and yeah, there's a lot more to be done there. There's some uncertainty there, but I don't think it's going to be nearly as bad. And who knows? Maybe these companies sell a little bit less, but at larger margins. Who knows? It
So
actually works.
yeah, looking at Target, it looks like the consensus estimate. This is the average of all of the guys that are covering it that put an earnings estimate out. It's about $1.68 a share, which is interesting because that marks a fairly pronounced year-on-year decline. It appears, and if you're right, it does. It's interesting to have a mild beat would not. It doesn't require something extraordinary. It just requires something ordinary,
Yeah,
because they earned $2 a share same quarter last year. So even if they were just flat, that would be a huge beat. I'm not suggesting that that's what's going to happen,
yeah. What was the
but
expectation? I didn't see. I couldn't see.
oh, it's $1.68 a share is
Okay.
the average. That's so if you just take a look at the average of the consensus estimates, Bloomberg's second measure. I don't know if folks can make this out. I'm
Yeah.
going to blow this up a little bit.
Yeah, I can't see it too well on my screen.
So I'm going to blow that up here. So the Bloomberg second measure is looking at 2.1% year-on-year growth. This is for the period ended April 30th, but they're actually going to be recording. Are they on a regular calendar year? I think they are. So they're going to be reporting through the end of March, I believe. Right? And
Yes, yes.
then
I don't want to say otherwise.
yeah, and then the Placer AI data. So just as a quick reminder to everybody, because we were talking about it before, but Placer AI, Placer is the alternative data provider that they track mobile phone use and movements, and they map those movements against known geographic locations, including retail outlets. So it's something like 30 million mobile devices that they're tracking, and that's obviously a sufficiently large sample size, and you can sort of see they don't know what the average ticket is for people who are going in, but they can tell whether the traffic is
Yeah.
going up or down. And actually, you know what? I apologize. I should have seen. Is this on a year-on-year basis, or is this? Yes, that's year-on-year. So interesting.
Yeah, that's a lot.
Yeah. So the Placer data does not look that great, and interestingly, they didn't have it. Their data for Home Depot also. This was kind of an interesting one because Home Depot looks like it's in kind of a technical. It's a little bit of a difficult situation here. So we've seen a big V bottom for a lot of names, and this one, of course, has come off the bottom somewhat, but it's still, to my eye anyway, it still appears to be in this little bit of a downtrend here, as you can see.
Yeah.
Certainly much further off of its highs than the rest of the market. And what's interesting to me here as well is that it was not that long ago. Actually, it was last year. I think we were looking at this, and it was trading at a discount to the broad market. It isn't really now. So it's what, $3.80 a share, and the adjusted numbers are 15, right? So this is full year. If I'm looking at, so it's 380 on $15, so it's trading 25, 26, 25 and a half times full year earnings estimates.
Yeah.
So not terribly cheap. What is cheap, and I think this is something that people ought to be thinking about. The options are very reasonably priced. I thought it's only implying a move of less than 4%, and so I was actually looking and saying, okay, well, if you own the stock and you want to be able to hold on to it, and this is not, I'm not expecting this is going to be some kind of a disaster. I'm just going to quickly frame up a very, sort of short, cheap trade. So I was just saying, you could trade a weekly tight put spread.
Yeah. Okay.
So if you figured that the move, where are we? What did I say? We're at 380 right now, 0.95. So if it dropped 5%, that gets you down into the 361-ish price range. I was just saying, you could look to a short dated, even a weekly, if you own the stock, or frankly, if you're even just contemplating taking a short-term speculative bet. A tight put spread like this one, like a 375, 360 is less than $4, right? So that's a $15 put spread, costs you 396, so a little over a quarter of the distance between the strikes. And if you get a 4 or 5% move to the downside, you're risking literally just about 1% of the stock price.
Yeah.
So
not bad.
So a 1% bet pays 3% of the stock price if their earnings disappoint. And that was just based on the placer data. It was based on the fact that the valuation has sort of crept back up a little bit.
Well,
and
if we go look at the real estate market, maybe there's some support for that because home sales are down. While prices of homes are not going down yet, the volume of sales is down. And of course, that's one of the reasons why people go into Home Depot and Lowe's. Mm-hmm. They buy a new place, and everybody wants to put their own touch on their new place to live. So, given that's a slowdown, that can be a reason why the placer data is coming in as it is.
Yeah, it's interesting you mentioned that. Well, there's two things, and that is that, yeah. The other thing I was going to say with respect to this is that, and we've mentioned this in the past, this is kind of blowing up a little bit, but Lowe's has much more of just the strict retail, and Home Depot has a much bigger portion of their revenues come from professionals.
Yeah.
So, the contractors and so on. And I've cited this statistic before, and I've apologized before for the fact that this is a little bit stale, but, my numbers were in the neighborhood of north of 40% was sales to professionals at Home Depot versus single-digit percentages at Lowe's. And the reason I'm apologizing for that number being stale was because that number had been reported, but I actually called the company and spoke to some folks there to get confirmation of those numbers a couple of years ago. And so that's why I'm saying, I'm reporting a number that I got from the horse's mouth, but I haven't spoken to them in quite a while, so that is a stale number. But it was a material difference that we were talking about. So let me just pull back up this. I'm going to bring this alternative data back up again. What you're saying is absolutely. Let's see if we can pull these. These are observed transactions. Let me see if I can pull this up. This is second measure. What I'm about to pull up here. So this is going to be, does that blow up? There we are. So this is the second measure data that I've been seeing from Bloomberg has pretty consistently on the consumer side been more optimistic than the placer data. I'm just saying what I've seen this year, because I look at both. They both come up by default. And so this is observed sales. We look at the number of transactions and the transaction values. So all of those seem to be tracking pretty consistently with one another. I'm going to just back this up to 6 months. So that doesn't look quite as good. If I move this out of the way. Looks kind of flat, actually, if we look at it that way. But, bear in mind, what was 6 months ago, that was still holiday season.
Yeah.
Right? So if you're looking at I don't know how much holiday shopping goes on at Home Depot, but probably a decent bit. Another name that I thought, not one we've spoken about very often, but is going to be reporting, is Ralph Lauren. And I was kind of, they have quite a nice free cash flow yield and still some decent top line growth, and not really, for a retail name, they really don't have much debt. So let's just call it a $17 billion company to make the math easy, $900 million worth of free cash flow.
Yeah.
So that gets us to a 5.3% free cash flow yield. It does look like it's forecast to drop a little bit next year. I'm not sure why that is, because they have, look at this. I mean, the company's actually been growing the top line. It's not a growth company by any means, but they've certainly been keeping pace with the economy, which is always something I like to look at. Their margins appear to be holding up. You have any thoughts on Ralph Lauren here?
I always like Ralph Lauren because they have a classic look that doesn't seem to go in and out of style. So the other especially retailers tend, to have a little bit more fad element in their products, and their age group, can go from 20s into 40s and 50s, and so I think that's what makes their company, resilient. And so I like Ralph Lauren quite well.
I guess the word you're looking for is timeless.
Timeless, yes. It's a lot of things go in and out of fashion.
I was checking to see whether I was wearing a Ralph Lauren sports jacket. I'm not. It's Brooks Brothers.
No, I used to wear lots of it when I was in the corporate world, and I don't anymore. But that's all right. I don't have the need for most of the stuff that they sell. I'm a terrible person to use as an example for retail sales because I don't want to buy anything. I don't really want to buy anything. I've got plenty of clothes. I've got 4 or 5 suits that are not going to wear out because I don't wear them enough. And it is what it is.
It's amazing. When you and I were first starting out on Wall Street and people wore suits all the time, I knew many people who would buy a suit and they would get 2 pairs of pants with the suit.
I did too. I did that as well.
Yeah. Because a very common thing was for us to wear a suit to work and you take your jacket off.
Yeah.
Once you get to the office, you hang it on the back of your chair or on your office door or whatever, but your pants wear out. Nowadays, everybody gets seen on a Zoom session, so, the pants I wear probably come from Costco. They're very utilitarian and hard wearing, and I wear a sports jacket in front of the camera, and that's pretty much it. Except for today, because a little bit of a change of pace. I'm going to be on Fast Money this afternoon for the full hour, but I'm going to be doing it from CNBC's San Francisco bureau at One Market. In fact, I'm going to be heading over there pretty shortly.
Yeah, so you won't be able to wear your pajama bottoms for that one.
Yeah, no. This is kind of a funny story. He's probably not going to like me sharing it. But when we first started to go to the remote setup for CNBC, Jim Urio, who you may know, he's a CME guy, works for TJM, longtime Wall Street guy, trades futures, options, all that kind of stuff. I like Jim a lot. And he was a CNBC contributor at the time. And they handed out these machines that, basically they connect to, as a camera and a little iPad, and you can set it up. And, we always had to figure out how this thing works. So anyway, he was going to do an early morning hit, apparently, from his house. And he was apparently setting this thing up. And, it's early in the morning, whatever. And Becky Quick, when he finally does come on the air later, because he had set it up earlier, Becky Quick is talking to him, and she says, this whole remote setup thing is pretty strange, isn't it, Jimmy? He said, yeah. She said, I have it on very good authority that you wear boxers and not briefs. So apparently he had accidentally gotten this thing
turned on while he was
he had come down and he was trying to figure the whole thing out, but he wasn't fully dressed, and apparently the control room at the network was watching him do all of this. I'm sure a lot worse has happened than that.
A lot of guys do that. They wear very flamboyant pants because they know they're not going to be seen, but they'll got the red tied white shirt and sport coat, and I personally right now I'm in shorts, so
Yeah. And a t-shirt.
And a tee.
Well, Mark, and it looks like your battery something just died.
I thought it was plugged in. Let me go see.
Well, we can hear you, so that's good news. It seems to be coming through a different. Yep. Oh, okay. So let's fire up social and take a couple questions. Oh, Placer AI data for Target. Did I show that already? Let's get that up here. So Placer AI. So the Bloomberg second measure data for Target is positive, but it is below industry. You know what's interesting is that the Bloomberg second measure data is consistent with Mark's assessment that things aren't as grim, because they've got industry up 5.5% year on year. Placer AI's foot traffic is up 0.3%. So like I said, can I do this Placer data monthly? Let's try that. There we are. Can you see this? There. So the blue line, if you can't make it out, which I apologize, I'm sure it's very hard to read. The blue line is median supercenters, and then this is and the white line is Target overall. So that's down 2.8%. That's according to the Placer data. Spicy barbecue tasty. Morning, gents. Good call on the UNH short put. My question: using line of credit for investing. Thoughts? Ooh.
No, don't borrow money out to buy this.
I'm not crazy about using a line of credit for investing. I don't take issue with borrowed money being used to invest in stocks. That is a bit of margin. In certain circumstances, and what would some of those circumstances be? And I mean, this doesn't do you a whole lot of good right now. I can appreciate that. But what would be an opportunity? Well, an opportunity to do that is when you think stock prices are grossly depressed and borrowing costs are also grossly depressed. So we had a circumstance in late 2008, early 2009, where the margin interest expense at most places was very low. I am talking about less than 200 basis points. I think at Interactive Brokers in 2009, you could get margin 1.5%, something like that. It's very, very cheap. And then again in the pandemic, this happened. But those circumstances tend to be rare because there's two problems that I have, and that is that oftentimes if you're borrowing money to buy stocks, the stocks are not. There's a cash flow issue partially. I mean, you're going to be incurring margin interest regularly, and these instruments are not distributing cash to you. So you're going to have forced sales for one of two reasons: forced sales effectively to satisfy that, or you are going to have a forced sale because the stock prices actually continue to decline or go down. And so I don't mind a little bit of borrowing, but I would not recommend taking out lines of credit and then putting that money into a margin account and levering up this way. I think that's...
If I could chime in on that too.
Mm-hmm.
Take a look at the S&P 500 last 100 years, about a 10% average return. Go look at the borrowing rate for TD, Schwab, Bank of America, Fidelity, Wells, pick your brokerage firm. They're probably in excess of 10% right now. So
Oh, really? You think they're that high?
yeah, Interactive Brokers right now is like 5.5, 6. Interactive is always less than everybody else by
Yeah.
500
Yeah.
basis points.
Mm-hmm.
Um, and so you got to bear that in mind. It's like, okay, you got to have an opportunity where something is going to happen fast. Now, what
Yeah.
I do, if I do want to have a little extra juice in a trade, I might buy the stock and then also sell an at the money call or a little out, I'm sorry, out of the money put
Mm.
or near the money put. So so I have a positive carry, the option's going to decay. But that's a super rare occasion. And I know you used to do, what some risk versatile. What is it used to do you used to do synthetic cash and market
Yeah,
making.
I
So
used to
that's beyond
do.
what our listeners should be doing, but do a lot of things. We had opportunities to do things that avoid the interest payment.
Yeah, I mean, a couple things would. So first of all, within a bank, and Mark and I both worked at banks, and the nice thing about that is that our reality for how we could borrow and lend money was different than how everyday folks get to do it.
By a lot.
And actually, the other thing was that I was charged for the capital I used. So the Treasury Department at Cantor, for example, would monitor how much, and this is wholly appropriate, of course. I mean, the bank's treasurer should be paying attention. That trader uses this much money, that trader uses that much money, and we want to make sure that they recognize that there's a cost of capital, that we reflect that cost of capital, and that they meter their trades to say, okay, this is an attractive do, even knowing that I have to borrow capital in this way. But the funny thing is that in the options world, there were ways for me to get exposure synthetically, as Mark is pointing out, where the capital requirements could actually be much less than it would be if I had to, say, post to purchase stock. And one of the things I would sometimes do, I liked call spread risk reversals with a slight ratio. So basically, if I would buy, let's just say for the sake of argument, that I'd buy $10 million of a $100 million stock. I mean, of a $100 stock right here, right? So, a way to think about that is, here's how many shares I would buy. Well, if I'm doing a call spread risk reversal, I could sell slightly out of the money puts because the strike was lower. So if I'm selling a 90 strike put, I'm actually buying the stock at a 10% discount. I could sell 1.1 of those for any upside that I was effectively purchasing. And I'm not taking more risk than buying the stock because either way, I'm still risking getting long $10 million worth. But actually, I'd be long 10 million at a 10% lower price. So in a 15% down move, I'm actually losing less money than if I bought it outright. Plus, my capital requirements were lower the way the bank calculated my capital use. So that kind of thing, again, it doesn't really apply to you guys. I recognize that. But yeah, you need to. The other thing is, think about this, is to Mark's point. If your expectation is that your assets are going to make 10% and you're paying 7%, so you've got a 300 basis point spread, but you're getting a 300 basis point spread. So that's how much money you expect to make, because you're going to make 10 and pay away 7. But you're doing it for substantially greater risk than the 10% that you'd be making on your cash. So that those incremental purchases you're making are coming at greater risk with lower returns. So if you get your timing right, that's fine. But I would probably favor just using, if you want a little bit of leverage, buy some stock, maybe buy some calls. I've done this when I've owned stock. I did this in Halliburton a couple of years ago. Owned the stock fell. And I was thinking, oh man, I thought it was so dog cheap before, I've got to buy more of it. But I didn't want to put more capital into it. So what I actually did was I sold half the stock and used the proceeds to buy long-dated calls, betting on a rebound. So I just didn't want to deploy more capital into it, So that was kind of how I got that leverage. Just buy some maybe even slightly in the money calls you could buy. Something like that. So you basically have defined risk, because it can get, the first guy that hired me into the business, he was fired very shortly after he hired me, actually. And the reason was because he just fell madly in love with the stock, and it went down. And every single time it went down, he just figured, oh, I'm just going to buy more of it and more of it. And I mean, I can still see him. I can just see him sort of leaning back in his chair and like this, looking at the screens every day as this thing just bled away. Now, I was new, and he was sort of like the most senior guy there, so I didn't really know what was coming. But then, one day I walked in, and he wasn't sitting there anymore. And somebody came in and said, we're blowing this whole thing out. So, yeah. Oh, yeah, here we have... Monday morning quarterback. What happened to that? Where was that question I just had? Oh, okay. So that was this. Yeah. NVIDIA collars on 80% of your position. Jan 140, Jan 150, Jan 170. Thoughts about managing? 140, 50, 70. Is that the one? Out of curiosity, Monday morning quarterback. Was that put on a long time ago, and you have something like a 150-40 put spread, short 170 calls, something like that? I'm curious. So, just let us know. I'm going to build that. I'm going to assume that's what you meant, but it might not be. So let's just put this up real quick. Now, I happen to like that strategy. I actually talked about it, although I think I would have used slightly broader strikes if I was going that far out in time, because if that's what you have, a $10 wide put spread that expires in January on a $150 stock is actually not that wide. Just if that's what this is. So we're going to wait and see. So I'm going to build this out as if that's what you had, and then we're going to find out what the details are. So we're going to assume you've got the short 170 calls. You rolled the 180s to the 140s last month. Okay. But those probably would then have been the 180 calls then? So you rolled the calls down? Is that I guess that's probably what we're dealing with here. What are your thoughts, Mark, while I try to construct this?
I don't know. So he's got that call spread risky. I see with NVIDIA, I'd rather have the upside, because I think the surprises are to the upside, and we saw that with the president's trip to the Middle East. Is those Middle Eastern countries want to get in the game of data centers and AI as well. So as we were thinking, the purchasing of their chips were kind of peaking out here in the U.S. Boom, another big slug of demand shows up, and which I thought was likely to happen. I didn't think volumes were gonna shrink. They were gonna stay up, and then the rest of the world's going to get involved. I mean, because really, you think about the investment there, it's really been a few countries in Asia and the United States. I don't really read much about data center, build out in Europe, for example.
Yeah, so I would say the following. I kind of, I'm with you because the multiples on a forward basis, and everybody who has talked about how long can the spend go on, I don't know exactly. But they don't have any immediate competition. The growth continues to be there. Every one of the companies that is spending huge on CapEx has not indicated any interest whatsoever in slowing the pace of their spending.
Yeah.
In fact, they just continue to reaffirm it and emphasize its importance. So just looking out to January, let me just say that the position that I had liked for people who were long the stock but were concerned about a pullback, and now that we're getting back up to these higher levels, I think this is still valid. What I was seeing was, and let me just, I'm going to build this thing out. It's going to be long stock, We're going to be long puts. So I'm just going to buy maybe, let's take a look at, say, the 130s, and then short some lower strike puts. We'll just get down to, say, the 110s here. And then sell some upside calls. And it could even be something like the pars, actually. And then sell some upside calls, up a ways, like this, maybe even more. I mean, I think you do need to give yourself a lot of room to the upside. So something like this. I don't know if you can see this, but you can see that's definitely an asymmetric payoff. You're not paying out much in terms of decay. You're giving yourself, in this case, $25 worth of room anyway to the upside over the course of the next 6-7 months, and then you give yourself a decent amount of protection to the downside. And I think at these really lower levels, you're going to be getting long the stock at pretty attractive valuations. You can pull a lot of that anticipated upside out of it and still be reasonably priced if you own the stock, down around $80 or something like that. I mean, so. Yeah, that was kind of my thinking. And in fact, I actually advised a former employee of NVIDIA that this was something that they could do with their stock. Now, there's some tax consequences, so depending on, get some tax advice from somebody other than me. I'm not a tax attorney. But, to me, I think that's a fairly attractive structure. And then you kind of set it and forget it and live with that. So Monday Morning Quarterback says, as long the Jan 120s, the 100s, and the 95s. Yeah, I like the long 120s and pars. I mean, the 95s, I kind of, like I said, at some point, you kind of feel like insurance below that level is probably a little bit less important. You're getting a pretty compelling value if the stock's trading around $80. So 15% decline from, we should be willing to accept a 15% decline in a stock we own. $80 is a little bit more than a 15% decline from 95. So I'm not sure how important that put would be to me, but I'm generally favorable on the company. So this is a good one for you, Mark. Strike options. So he's talking about the MicroStrategy. Now they have the preferreds.
So there's some options on the preferreds. I wasn't aware that there are options on the preferreds.
I didn't. I'm gonna see. I have actually not even looked at that. So let's see. No, it has no listed options. So no strike options. I wasn't aware of that either, and that would have been unusual. I haven't seen that all that often. But first of all, I guess one of the things I would say is that these instruments have some embedded optionality in them, right? So just like the zeros do, the zero coupon converts. You're lending money to the company. The company uses those proceeds to buy Bitcoin, and in exchange, you get a call option on the stock of the company. And so the preferreds are kind of an interesting situation because, in this case, the advantage that all of these instruments have is that you're a senior in the cap structure. So that's definitely a benefit. Mark can probably speak to both that and, I know you've been very active in MicroStrategy.
Yeah, so I like to trade their options. I like to sell cash covered puts from time to time on the name. I own some of the stock, some stock as well. I bought 100 shares of STRK for the fun of it when it first came out. I wanted to see how it was going to trade, and I got it about the offering price, maybe a couple of bucks higher, I don't remember. But STRK, I think it's an interesting way to get exposure to Bitcoin, particularly if you're somebody who needs some income. So income, Bitcoin doesn't pay any income; it's a commodity. So like it's your gold or silver. So if you are living off of income from your investment portfolio, then it makes sense to hold that instead of some Bitcoin. You get some upsides because if Bitcoin takes off, MicroStrategy stock is, or now as it's called Strategy stock is gonna take off, and you're gonna enjoy a capital gain. But in the meantime, you're going to get a coupon is for you to live on. So I think it makes a lot of sense. And if you want a little bit more income, then you go to the other one. I forget the ticker on the other. I could look it up real quick.
Stripe.
Is it Stripe STRP?
Yeah, I think yeah. There's Strike and Stripe.
Yeah. So,
and then of course the yield. So the yield max. Is that what it was? What is it in the Bloomberg terminal to get this?
The other advantage, Mike, is as I understand, these are qualified dividends.
Yeah.
So you pay a lower tax rate on the dividends than if you were to buy the company's debt.
Strife. Thank you, Mike. Mike just reminded us it's Strife, STRF. So STRF. So I'm going to take a look at this perpetual preferred and see what that dividend was last. So I guess, yeah, I mean, Misty is, another type of a structure. So what are these things doing? What you're really doing when you get one of these instruments is you have become a volatility seller. Now the difference is, so when Mark is a volatility seller in MicroStrategy, he's probably getting a yield that is higher than the yield you would get by trading these preferreds. And that's because the implied volatility on the underlying stock is so high.
Yeah.
The downside to that, does that mean it's a free lunch? No, it doesn't mean it's a free lunch, because the equity is subordinate to the preferred, subordinate to the bonds, and so on. So as you sort of fall down the waterfall of the cap structure, you would expect that the volatility of the things at the bottom is greater than the things at the top.
Yeah.
And you're trading risk and reward. You have, I guess the nice thing, though, is that at least when you're doing it as you do it, Mark, on strategy, you get to sort of pick your spots rather than just having it done formulaically.
Right. Yeah. When I think that it's sort of been beat down, and it's a low risk opportunity, the implied volatility in the options are quite high. They typically trade 70, 80, 90. A lot of times when there's like a real quick beat down on the stock, it'll trade as high as 100. So I pick and choose. But to your point, I think MicroStrategy is up about $100 or there in the past couple of months, and STRK I think is up about $10. So it gives you an idea of the volatility difference between these two instruments.
Yeah, it's more than 100 since the April lows. It was traded below 250, and now it's above 405. So it's up. We'll say it's up 60% plus.
Yeah. Now go pull up STRK and take a look at that, and over the same time period, it's
yeah, that went from 78. It went from 80 to 100. Well, that's not bad.
No, it's not bad. It's you got hedge delta in it because it's got a long dated call in there. So when the stock rises, the value of that instrument is going to rise. But as you can see, the percentage move is not as big. So
yeah, it's a lower beta. I guess. Yeah, we could describe it as lower beta, senior in the cap structure, and it pays you a yield.
Yeah.
So, this is a pick your poison kind of a situation. I mean, I kind of, I kind of like them all, and you choose the one most suitable for you.
Yeah.
Or you can spread a little bit out, rather than just say if you're going to commit some capital to the whole complex, you can buy a little bit of each. And I think that's also fine.
Well, given the leverage in the stock, you should not be surprised to see MicroStrategy go from $400 to $200. or
Yep.
trade up to 450 and then go down to 250. And that kind of price action is not good for some people's health. You know, that's too much. That's too stressful. And you should never buy an instrument that is more volatile
Then you can stomach.
than you can stomach. So if you buy it, you think you can, if it goes down 200, that you're more inclined to maybe buy some at down 200 than like panic and sell. Maybe it makes sense to own it. But if you're the type that's going like it's going down, I'm getting really worried, I'm going to sell it. Use one of these lower volatility instruments like STRK.
Yeah, and as you earlier pointed out, if you depend on this for income, then, well, if you depend on it for income, then you should be choosing the preferreds for sure.
Yeah.
And the reason, there's for two reasons. One, if you depend on it for income, you need the income, and also you don't want a whole lot of volatility. If your net asset value is taking wild swings, you're just not going to sleep at night.
Yeah.
Now, Palantir, this is an interesting one because now we've already violated the all-time highs just recently. And wow, when we think about valuations, it's hard to get to ones that are bigger than this. This thing's trading 100 times trailing 12-month revenues.
Yeah, it's crazy.
It is So the question that we've been asked, and I think I got it on the screen. Did I put the wrong one up? How to trade Palantir with current high valuations. Is it sustainable? What are your thoughts?
I was very interested in this as it was going down, and then I got very busy at school and quit paying attention. Then all of a sudden it went from like, what was it, 5 or 10? It was trading at 50 or at 60, and I was kicking myself for missing it. And I just said, even at that price, it was too high. I'm not going to play. Mm-hmm. And turns out there was another double to be had. It went from there, I think, to about 140. I don't know how to trade a stock that at this stage, I would say has nothing to do with value and everything to do with emotion. Mm-hmm. And so, you know, maybe the Wall Street bets guys have a hold of this one. I don't know how this has been squeezed as high as it's gone. But
so this kind of goes to the thing you were just talking about. You were mentioning, you know, are you the type of investor who is likely to get long more as it falls, or are you going to get stopped out? The thing is, when you deal with a company whose valuation is so speculative, it is very difficult to have any form of conviction. I mean, what's a fair price for the stock? I don't know the answer to that question. I don't know that any of us do. It is priced right now as if the company is going to, I mean, let's take a look at what they're, now, granted, they are not like the regular, they have a lot of government contracts and things like this. The advantage that the company has is it's one of these ridiculously profitable businesses in terms of net income margins. I'm going to use 40% as a round number is what the street seems to be looking for. It's actually slightly less than that. But why do I say this? The nice thing about using a nice round number is that let's just say that someday we think that the company is going to reach a pace of a more nominal growth, 10, 15% growth, right? What would the company's net income need to be to deserve a $300 billion valuation now based on what it will do in the future? So Mark, I'll let you talk about that. So as you think about it, what is a $300 billion company? What is it anticipating? What are buyers anticipating the net income of this thing will be in the future?
Well, you could do the math. So a back of the matchbook is take 300 million equals some dividend divided by R minus G. And so R for a company like this, proper discount rate, is probably something like 15%, 18%, because it's probably a beta of 2.5. So call it 18%, and it's like you were saying, a growth rate of, a long-term growth rate, 5 to 10%, call it 10%. So take D divided by 0.08. equals 300. Solve for D. I don't have a calculator here. So 300 billion dollars, 0.08 times. They would have 24 billion in earning and dividends sometime 10 years from now.
Yep.
Highly unlikely, but and that's, well, I don't even think they can grow. You can grow into that valuation, and any near term
that number is 12 times full year 2026 times numbers.
Yeah. So
it's a lot. That's a lot of growth baked into this cake.
I'm not
going to say
inclined to try to figure out how to way to get short it, but I'm sure the options have 60 or 70 vol attached to them.
Oh yeah, these are high vol. It's actually not such a huge short interest.
So I would buy a put. I mean, buying a puts are, you're gonna
off the charts. It's actually, you know what, on a realized vol basis, believe it or not, it's actually in the mid high 60s. So 3-month implied at the money implied volatility is about 67.
Yeah.
In round numbers. To me, it's kind of a no play though, because I'm not going to short a stock that's behaving like this, and I'm not going to buy it either because I just can't get behind the valuation.
I don't trade stocks like this.
Yeah.
I don't trade stocks like this. I will watch from the cheap seats. And have my
so Mike says Palantir is driven by retail, so is MicroStrategy and STRK. I would disagree a little bit on this because the MicroStrategy valuation is based on how accretive you think their financing activities can be, and then the underpinning price of Bitcoin. So they have a book value associated, a tangible book value associated with their Bitcoin holdings. They have a net accretive effect as a result of their creative financing structures to acquire more of it. And then you have a long-term perspective on Bitcoin. So I don't think it's as speculative in the following sense. What is the premium right now on MicroStrategy to Bitcoin? Like 2.5x? 3?
I think it's 2x, yeah.
Yeah. So in other words, if you look at a share of MicroStrategy, you might say 35% of the value of this share is their actual Bitcoin holdings.
Yeah.
So then the rest of the value assigned to the enterprise is what you think they are going to do over time. So just discounting whatever they might do to the present and then saying, okay, this is the value associated with that. Knowing that there's an accretive effect. So what is that accretive effect? I've gone over this, but in a very simple sense, if somebody loans me money at no interest, and you can use that money to purchase Bitcoin, and I will give the lender to me the right to buy my stock at 100% higher than where it is right now. What's the accretive effect to Bitcoin if Bitcoin is trading at 35% of my current share price? Well, what that means is that even if my stock eventually converges to Bitcoin at some higher level, I have a lot that I can capture in the middle. And that's what the shareholders are expecting. They're effectively getting financed call spreads. Actually, somebody was asking about taking out a line of credit to buy. Well, Michael Saylor is sort of, he's allowing you to get that leverage in Bitcoin without actually taking on that leverage yourself. The value to the shareholder of MicroStrategy is you get a levered play on Bitcoin, and it's levered on the first bit. So you essentially own call spreads. That's what you are acquiring when you buy those shares without having the risk that you get a margin call.
Yeah.
How about that?
Yeah. And he's one of the reasons why now he's sold these yield instruments to finance, to buy, but he's also selling a lot of stock. Because he's selling the stock for twice the value of the Bitcoin that he's buying. So he sells stock at $400. He's buying Bitcoin at equivalent of $200. And so the number of Bitcoins per share continues to go up. So he's got an arbitrage that he is playing. And as long as the arbitrage is there, he's going to keep doing this. And in fact, they just expanded their program. A week or two ago, they announced that they're expanding their acquisition program.
This is an unusual circumstance because it was really, really common in the old days. When I say the old days, like when you and I were newer in the business, secondaries were not usually considered to be big positives for a shareholder. But in his case, they are, because he's got the quirk that he's exploiting is that a secondary is accretive.
Yeah.
That's the weird thing.
And people are getting confused because they keep saying it's dilutive, simply because they're adding the number of shares, and it's not.
It's accretive.
It's accretive. It's not dilutive. And so people that are telling you what they're doing is diluting the shareholders by issuing stock. They are not correct.
Yeah, and actually, with respect to the power law. So Mike is pointing out that he looks at the power law, log charts on graph on Bitcoin, which you also do.
Yep.
Well, you actually look at it a couple different ways, but yes. So you things to look at. Obviously, when we had the halvings, you could sort of see a pattern exhibited there. You'd have a halving, you'd get these step change. It was sort of like a step change function.
Yeah.
And then the power law also, which seems to do a pretty decent job actually because if you just look at a regular price chart, it just looks like a big mess. It's very hard. But actually, when you start to try to normalize it with some of these techniques, you do get a resolution that starts to exhibit some forms of a pattern. So we have taken up an hour and a half of your time.
Ooh.
Mark had a hard out, which was the reason that we ended up doing this early. And I have a hard out too, because I actually have to get into San Francisco to get to the CNBC studio to do Fast Money and meet with some of the people there ahead of that show. So for those of you who tuned in at this unusual office hours hour, or hour and a half, we really appreciate it. And are we going to be doing it more at this time than...
This time works much better for me because I'll be taking Wyatt for swimming lessons. And I think this will be his time, but I don't know for sure at 3:30. So I think I got to do it earlier.
All right. Well, learn to swim, Wyatt. I'll tell you this much. When my kids were learning to swim, it was excruciating because I could still remember Tommy screaming, "I'm drowning!" And the teacher says, "Maybe it's better if you're not here. He won't drown." So I was like, "Okay, in your hands. I'm just going to go someplace where I can't hear."
That's funny.
All right, everybody.
Water,
thank you so much.
I'm hoping he does the same.
Well, thank you as always, Mark, for your insights. Thank everybody for watching. I hope you all have a great weekend, and we'll see you here next week. Thanks for watching.
Bye.